Spreads going on here. That's something we need to talk about, especially since it's actually kind of a contradiction to what's happening across the rest of the credit markets. So what we've seen is junk credit spreads that are compressing, and then some investment grade corporate credit spreads that are hitting new lows we haven't seen since the 1990s. In fact, they're lower than they were in February when I pointed them out as almost peak complacency. But yet here we are back again with the marketplace reaching for yield and justifying that reach for yield by, among other things, upcoming rate cuts from the Federal Reserve. At the same time, we have a contradiction, not just in terms of risky credit and junk credit, corporate credit, but also in commercial real estate. Remember commercial real estate? There are losses piling up and delinquencies piling up, especially in places like CMBS, that are signaling that investors are ignoring these risks for their own reasons, but mostly because what's happening is the marketplace is bifurcating in many ways. There's the reality of places in the credit markets like corporate credit, or in commercial real estate, where you can't get away from delinquencies, you can't get away from bad cash flow, you can't get away from the fact that the situation is not improving, which was the whole point behind extend and pretend. And ironically enough, because of the extend and pretend and because of what is perceived to be the successes of extending pretend, what everybody's calling resilience in commercial real estate and CMBS, that's where this fear of missing out is coming from in the corporate side, because it seems understandable, even reasonable to say that if we've been talking about commercial real estate for years and nothing has happened, therefore maybe we're overstating the risks, and so there are no risks over here in corporate credit. And if interest rates are going to go down because, well, the Fed's going to cut rates, then now is the time to slam into risky corporate junk bonds, because as rates go down, you're not going to see these yields for quite some time. So we got a lot of charts to get into here today. Like I said, corporate credit complacency, which, by the way, is never really a good sign. Complacency means you're not protecting yourself nearly enough with additional return, and you're underestimating the risks, which we've seen repeatedly throughout the last several years. So, like I said, chart deck here. Hold on just a second. All right. All right, it really is a contradiction. I mean, on the one hand, you got corporate spreads, especially the triple Bs. Those are the ones that are being highlighted right now. Corporate spreads dropping precipitously. You've got the lowest triple B spread since, I believe, 1997. We'll check that out in a second here. We'll get to the chart. But there are some lingering macroeconomic and doubts about risks. It's not just in the more riskier ends of the spectrum, like the triple Cs, you've seen spread compression, but it hasn't gone all the way to the extent that you've seen in investment grade. So while there's some reaching for yield, it isn't full force reach for yield in the riskiest aspects or the riskiest parts of the credit markets, which goes along with the reality of those credit markets. So what investors are doing is reaching for yield selectively, because they do realize that it's not strictly recency bias is one thing, but there are concerns to be aware of, and concerns that are very realistic. So we can't just, it isn't a complete generalized, let's just screw it, throw everything to the wind, throw caution to the wind and buy anything and everything. But there is a lot of reaching for yield going on, even in triple Cs, but you can still see the lingering doubts. That's why they're lagging behind. And one of the reasons why is because while the reaching for yield in investment grade credit makes some sense for, given the circumstances that we find ourselves in, there's still this, we still see the reality of commercial real estate, which suggests that this thing is not, we haven't gone through what we're supposed to be going through. It's simply just a process that is playing out over a long period of time, which leads to these massive distortions. That's why we're calling it a contradiction here. And again, rate cutting expectations are one of the reasons we're seeing such a huge reach for yield here, especially here in August, because a lot of investors are expecting that, okay, we went through April, nothing bad seems to have happened. That's one interpretation. That's an interpretation that's aligned with the stock market. We went through April, it was an overreaction to tariffs, no economic damage, no financial damage. Therefore, it makes sense to go into some lower quality corporate credit before the Federal Reserve starts cutting rates, without ever asking the question, why is the Fed cutting rates again? A lot of people have justified the rate cuts as, well, there's no inflation risk. We haven't seen tariff inflation. Therefore, the Fed's cutting rates because of the absence of inflation. But that's not why the Fed's cutting rates, and that's not why we continue to see extend and pretend not get to the promised land, because the underlying economic fundamentals haven't actually shifted. So that's really the contradiction. On the one hand, being able to talk yourself into reaching for yield and saying there's no risk to doing so, and then the other hand saying, well, one of the reasons why I want to reach for yields because low rates are going to go lower, without reconciling those two positions. Meanwhile, you've got commercial real estate and some of the riskier corporate credit parts of the marketplace sitting there saying, hey, remember me? Not everything is great today. And what happens if not everything's great tomorrow? The riskiest parts of the riskiness parts of the last couple of years have never gone away. In fact, they're the reason why the Fed is going to be cutting rates up ahead to begin with. So you've got a combination of, this is what the contradiction is. You've got a combination of recency bias and complacency over risk, misinterpretation of what happened in April in particular. It's calling it all resilience when it's really just, we haven't seen a major crisis, therefore the belief, this is the recency bias, therefore the belief is because we haven't seen a major crisis, the system is robust enough to withstand anything, therefore there really is no risk. And with the Fed cutting rates, better lock in some yields before the yields start to go down even more. So you see, CMBS, we're talking about commercial real estate, delinquencies on the rise, which we'll get to here, all of the nastiness that everybody knows about and has been talking about, yet issuance is high and has been high, though a lot of that was in the first quarter because people are just ignoring the downside, thinking that there is no downside because we went through these various shocks and it didn't lead to something like 2008 or even just 2023. Therefore, any additional yield is more than justified because we're overstating the downside that doesn't actually exist, even though we can all see the risks and the downside in things like commercial real estate. So it's a contradiction when it's really just, how do we justify reaching for yield? Because these yields are probably the best we're going to see for quite some time. That's really what it comes down to here with the compression in corporate spreads. So let's get to the details here. The corporate credit spreads. You see the Master 2, which is one of the main high yield indicators, hasn't gone back to where it was in February. And remember, I pointed this out back in February. I said, look, low credit spreads that we're seeing back in February, never a good sign. Investors are complacent. And what that means is when they're complacent, they don't have enough protection. Therefore, they're susceptible to a small little thing, a small little piece of doubt, triggering a major backlash, which is exactly what we said, or exactly what we saw in March and April. Now, the backlash wasn't 2008 crisis levels, but it was enough and it was severe enough. And had it gone on longer enough, it could have led to some severe consequences. But fortunately for the marketplace and specifically shadow banks who are heavily invested in not just commercial real estate, but also risky corporate credit and direct lending and things like that. Fortunately for them, two things happened. President Trump came out with his policy declaration on, or at least the announcement that they were delaying tariff implementation for 90 days on April 9th. Plus, as we've talked about with the tick statistics, U.S. primary dealers in particular came in and redistributed funds through repo on less than good collateral, which is one of the reasons why spreads stopped rising, is that the dealers were taking crappy collateral, which kind of interrupted the run on the collateral. That combined with the announcement of the tariff delays is why credit spreads rose sharply, but then stopped and started to reverse. Then the interpretation of all that was, oh, it's just a false alarm. No big deal. We went through what seemed to be pretty chaotic and disorderly at the time, but we came out of the other side and look, everything's fine and dandy. Haven't you seen the stock market and the NASDAQ? They're soaring, even though the credit spread, junk corporate spreads in particular, are just the other side of the stock market. But focusing on the triple Bs, that's where a lot of the tension is. You see that the credit spread has fallen under 100 basis points for the first time in 27, 28 years, going all the way back to the late 1990s, because you have this desire to get these yields while you possibly can, because if rates go down, we all know rates are going to go down. They're not coming back. This might be the last chance to take advantage of what seems to be a one-time windfall. A lot of investors have been staying out of the corporate market over the last couple of years, not wanting to get into and not wanting to lock in these yields. Number one, because they thought rates are going to continue to go higher. So they've been sitting out waiting for rates to get to their final point. And number two, the risks didn't seem like they justified. Plus, there was no urgency to buy into corporate credit with the last couple of years, because it didn't seem like circumstances demanded immediate action. But here we are in August of 2025. You've got the one interpretation of what just happened a couple months ago. You've got the Federal Reserve that's likely to continue cutting rates. Longer term rates are looking like they're going down. It's a bull steepening on the yield curve. And credit professionals are saying, this is the last chance. So let's just throw our money at the credit markets and let's see where it goes. Plus, I mean, you can justify that too by saying, okay, I don't have a lot of spread protection or a lot of additional return in the actual spread, but if the Fed cuts rates from here, and remember, a lot of people believe that, especially in this parts of the marketplace, that the Fed is controlling interest rates. So if the Fed is cutting interest rates, then I'm protected to some extent for some credit losses because I'll have an additional return over where nominal yields will be in the future. So there's a lot of reasons that are combining into this compression, some pretty sharp compression in spreads here in the middle of August. A lot of it has to do, and I think the most important point for our purposes is the market is saying, yeah, we see rates going lower and they're not likely to come back higher anytime soon. So you go all the way back to the 1998, late 1990s for the last time you saw the triple Bs down this low. And again, that makes sense because it seems to be the sweet spot between the rationalizations about where the economy and the marketplace is and the I don't want to miss out on these yields. So let's take a little bit of additional risk, but maybe not as much. And you can see just back in April, it seemed like it was a pretty big deal at the time. It seemed pretty chaotic and disorderly, but in the grand scheme of things, it really did get short-circuited before it went too far. And that's something to keep in mind too, because the interpretation or the mainstream interpretation that is driving certainly the stock market is that was it. That's all we saw. But what would have happened if U.S. primary dealers hadn't stepped in repo and taken bad collateral, or if the president hadn't announced a tariff delay? Well, the spreads would have continued rising. We would have gotten into that self-reinforcing spiral. So the danger here, and one part of the market is still sensing that danger, is that what if we don't have the same positive outcomes that we had a couple months ago play out in over the months ahead? And that's the same question we've been asking when going over the tick statistics and what U.S. primary dealers might do if this happens again. Will they step in the next time, especially if the macroeconomic circumstances, which is driving all of this, the rising credit spreads and these jumps in credit spreads, even the carry trade last August? What happens if macroeconomic conditions worsen more than they have? I mean, remember the last payroll report? That's why the Fed's cutting rates. What happens if macroeconomic conditions worsen and primary dealers say, not this time, give me some treasury bills or I'm not funding your positions? So that's the one part of the market where the contradiction is coming from. And you can see that still lingering once we get past the risks here in triple Bs. You can still see that lingering in the more the riskiest, the triple hooks and things like that. So spreads have compressed in the riskiest parts of the corporate marketplace, but not nearly as much as they have in investment grade. So that's, again, the contradiction. On the one hand, you say investment grade, okay, we're going to ignore what happened in April. We want to get into some decent yields. We want to reach for an additional return while we can. But on the other hand, while we're ignoring the risks of doing so in triple Bs and investment grade, we're not necessarily going to ignore them over here in triple Cs and some of the other junk bonds because of what we're seeing in corporate credit, and commercial real estate most of all. That has not gone away despite years of extend and pretend, years of officially sanctioned extend and pretend. So in historical context, even the context of the last 20 years, triple C spreads, they're closer to their lowest levels, their lower levels, or the bottom end of the range, and they are to the highest end of the range. But relative to where the triple Bs are, that's where the focus of this relentless reach for yield has gone to. So there's an awareness of macroeconomic risks and liquidity risks too, which goes along with it. But it's being set aside and dismissed and rationalized in favor of let's just get these returns in while we still can. So there's a high level of complacency going on in the marketplace, which is again, it takes a number of contradictions to really get there. So as Bloomberg reported earlier today, the dwindling yield premiums in the corporate credit market has raised questions of whether investors are becoming complacent again. I don't think it's raising questions. I think the answer is obvious. About the risks of rising default if the economy stalls. And again, that's why the Fed's cutting rates because they see the risks of the economy stalling, in particular labor market. And if the labor market stalls, that means less incomes mean more defaults, not just in terms of consumer credit, but also all across the economy, small businesses, medium-sized businesses, corporate, commercial real estate. Consumers go bad, commercial real estate's going to get worse, and everybody's counting on commercial real estate getting better. So there's a lot riding on all of this. After spreads peaked at 119 basis points, that's according to their index, in the aftermath of sweeping tariff threats in April. Analyst Noel Herbert, or Hebert, don't know which one it is, expected the figure to rally around 93 basis points, nearly a quarter point above the current spread. So even those analysts that were expecting a spread compression this summer have seen spread compression go way beyond what everybody was expecting. And the drop indicates that the bonds have grown unusually pricey as investors move to lock in current interest rates despite the risks to businesses posed by the slowing economy and U.S. trade war. Bond traders are betting that the Fed will follow suit, which they are going to do, cutting rates as soon as next month after recent economic release showed inflation was largely in line with expectations. The PPI notwithstanding, because of why the PPI rose there. And the labor market weakened. That's the big one. Labor market weakening isn't just a trigger for the Fed's rate cuts. The labor market weakening is the trigger for all of the bad cases in corporate and commercial real estate. And given everything that we're talking about here, it makes sense to talk about our sponsor today, who is Monetary Metals. And if you don't know Monetary Metals, I highly recommend you check them out, because as I recommend to people all the time, given the level of uncertainty, despite the complacency that we're seeing, the level of uncertainty across the real economy and therefore the impacts on the marketplace, the volatility, there's a reason why gold soared in April and then has gone sideways despite the re-risking in some of these credit markets as well as the stock market. People understand that not a lot changed. If anything that changed in April, it was really just a relaxation of the acuteness of what happened, as well as the urgency behind it. But it didn't eliminate the risk. They didn't go away. So gold is a hedge, not against inflation specifically, but a hedge against this level of uncertainty, as well as a hedge against potentially bigger downside cases should we get into the worst case scenarios. I'm not saying that's what we're seeing, but it's certainly on the table, especially given the level of complacency in corporate credit and the fragility in the marketplace that we saw in April. That's the big takeaway from gold, as well as swap spreads and all these deep financial indications, is that while certain parts of the marketplace are setting aside what happened in April and saying that's a one-off overreaction to tariffs, these other parts of the markets, including gold, are saying, no, we're probably going to revisit some of those assumptions in some point in the near future. So recommending gold, it doesn't give you a return outside of the price appreciation. So what Monetary Metals does, they give you the price appreciation plus an additional yield on top. We're talking about 4% paid in their gold leasing program, which, if you want to know the details about all that, just follow the link in the description here, the link on the screen, as well as the link in the description. It's monetary-metals.com/Snyder. I highly recommend you check it out. First of all, check out gold if you don't already own some. And if you do own some, or you want to buy some, you got to check out Monetary Metals about what you can do with it and earn an actual yield, in addition to price appreciation potential, which is key in this type of environment. Again, there's a reason why gold is going sideways while the stock market is soaring, because the gold system, gold investors, like these financial investors, see April was not necessarily just a one-off. So Monetary Metals, we thank them for their partnership and their sponsorship. There's a link in the description. There's a link on the screen here. Highly recommend it. So let's talk about complacency and the contradiction, getting back to our story here, in the commercial real estate market. And yes, these are linked. Corporate credit over here, commercial real estate over here. A lot of it is sentimental links. We know commercial real estate has been a disaster in waiting, a disaster in making. Everybody knows it. Everybody knows extend and pretend is going on, as we'll see just briefly here. The Federal Reserve Bank of New York, the bank regulators have basically sanctioned extend and pretend ever since the summer of 2023. They wrote letters to all the bankers and said, hey, you need to start working with your clients, not necessarily foreclosing on them. And the bankers said, yeah, we learned in 2008, we don't want to foreclose either. Everybody knows extend and pretend is taking place. Everybody knows delinquencies are on the rise because the economy's not going well. What everybody is hoping for, and this is the narrative and this is the idea that extends into the corporate credit markets, is that lower interest rates combined with a soft landing in the real economy, whether on its own or engineered by lower interest rates, those two things will create the Goldilocks situation where credit, delinquent credit, credit that's behind, defaults, they can all be worked out under not just sanguine conditions, but ideal conditions to take care of everything. And if that does happen, and extend and pretend actually works, we buy enough time to be able to reconcile what is really a credit crisis in commercial real estate, then everything will be just fine over here in corporate credit. So if you think extend and pretend is working, there is every reason to buy and reach for yield in corporate credit. That's the problem, though. Is extend and pretend actually working? Well, I mean, it's working in the respect that it's kicked the can down the road this far, but is it working in the respect that it's kicking the can down the road far enough to reach Goldilocks? That's where you see the gold prices and swap spreads and bull steepening on the yield curve, as well as the lingering doubts in the triple C's on the corporate credit side. But as far as commercial real estate, and specifically commercial real estate bonds, as Bloomberg reported a couple weeks ago, 23 billion of delinquent commercial real estate mortgage loans bundled into bonds have reached or are approaching their maturity dates, at least according to an analysis of the data analytics by TREP, who is the most well-known and well-respected name in anything related to commercial real estate, and really CMBS, with borrowers increasingly unable and simply unwilling to repay their debt. And that compares with virtually zero before COVID upended the market. We're starting to see a real gathering and rise in commercial real estate defaults and delinquencies. Delinquencies first, the defaults come later. Though, again, part of extend and pretend is not having defaults. It's, okay, I'll keep the loans in delinquencies, but I'm not going to mark them down and mark them to market. We're going to pretend that these loans they have a future where there can be a workout and they won't be put into default before the end of before everything really shakes out. As the article continues, distress is rising again in real estate because credit, taking out super low interest rates to build or refinance everything from apartment complexes to office buildings and retail outlets. And just to pause here, the bubble that happened in 2021 and 2022 wasn't necessarily about interest rates. Yes, that was part of it. But a huge part of it, as I keep pointing out, I did a video on this about Hong Kong real estate, which is very similar, and the Chinese banking system, which is somewhat similar. We are paying for all of the missed assumptions in the pandemic period. Everybody believed the government, the Federal Reserve, whoever it was, they responded to the pandemic in the most optimal way possible, that they created a recovery, not just a recovery, that one that went too far. It was red hot. That's where the inflation came from. The inflation was the heat of the economy, supposedly. And so everybody bought that narrative and went freaking crazy, especially in commercial real estate. And real estate too, residential real estate, but commercial real estate was where everything poured in for these ridiculous assumptions. So it wasn't necessarily interest rates, it was macroeconomic fundamentals. The idea that leases that had expanded very rapidly because of all of the distortions in the supply shock, these leases were going to be accelerating at the same rate for years into the future. Therefore, it justified every valuation, every cost, every increase, every loan and piece of leverage that these companies could secure. All of that was justified from the 2021 perspective. It was the bubble, the government response to the pandemic created. And that is one way that we still have to pay for the pandemic. We have to pay for that bubble. That's what extend and pretend is extending. It's extending the life of that bubble so that hopefully when the bust finally does shake out, it does so under more ideal circumstances. That's where Goldilocks comes in. So it's not just interest rates. You can't just say it's just interest rates. Everything's due for repayment at a time when borrowing costs are dramatically higher. And this is the key point. Tenant demand is lower pretty much across the board, and rents are not rising nearly as fast as they need to make up for the difference. That's why specifically commercial real estate, as well as multifamily residential real estate too. By one metric, the share of troubled commercial mortgage loans in late April was approaching levels that followed the 2008 crisis. And while that's a little bit hyperbolic in the, cherry picking some of the statistics, it's not as far off as it seems. Again, that's the lingering concern. The other side of the contradiction is, okay, if we get to Goldilocks and extend and pretend works, everything will be fine. But what if we fall just short? Now, I'm not talking about 2008. What if the economy tails off a little bit too much? Then the risks are entirely asymmetric, even with just an economy that maybe a dot-com style recession for something like that. Maybe just a small further rise in unemployment to like 6% or 6.1%, nothing like 10 or 11% like in 2008. The risks are entirely asymmetric, which is why the market is completely frozen and paralyzed, because we don't see the soft landing at the probabilities and the likelihood that would justify finally starting the price discovery process. As you can see here, delinquencies continue to rise, and everybody knows it. Everybody is just simply waiting for that moment where they can say the Fed engineered the soft landing, or the soft landing just helped, or just materialized out of nowhere. So despite the pileup of bad debt, so far there's been no prolonged market meltdown in commercial real estate credit. That's, as we'll see just a second here, that's not necessarily the case either. But this is the main point behind the complacency. We've been talking about commercial real estate for years. Everybody, not just me, everybody. Ask Ken McElroy, he'll tell you. Kenny knows this stuff. Everybody knows commercial real estate was in a bubble, and there is a bust just waiting to happen. There's been zero price discovery, or very little price discovery. It is going to happen. But you can look at that and say, yeah, everybody's been talking about it. We know it's a major mess, but it hasn't triggered a major meltdown or crisis. Therefore, it seems reasonable to interpret that as, well, the system is resilient. And so that narrative, that idea, transports over to corporate credit and other parts of the financial system too, stock market. If the commercial real estate system and that part of the marketplace is as bad as it seems to be, and we all know that it is, yet it seems to be manageable, then every other financial risk must be much more manageable. Therefore, it makes sense to reach for yield. I'm going to buy as much triple Bs as I possibly can to lock in these returns. But we all know that's reaching for rationalization too. Otherwise, we'd see triple Cs compress at the same rate as triple Bs. So while it seems okay to reach for yield in triple Bs and say I'm comforted by what's going on over in commercial real estate, or what's not going on in commercial real estate, I'm not going to go all the way into the risky parts of the corporate credit market, because there is still a material risk in the economy, as well as maybe the system isn't actually resilient as it seems to be, and maybe it's just a matter of time more than anything else. So that's one of the narratives, but not even the marketplace buys it. So can we get back to this as a major, it's a ball of contradictions all over the place, which in many ways that's what a market really is. Real estate lenders are extending the duration of loans rather than seizing properties from borrowers hit by value declines after the rise in working from home made offices less desirable. And again, that's technically true, but it's really the mistakes of the pandemic, thinking that it was really recovery. The availability of private credit, and this is a point I really wanted to get into, has also allowed some landlords to refinance at higher debt to value ratios. One of the reasons why the shadow banks came up so prominently in the April, I won't call it a crisis, but the April backlash, was because they have been extending loans that the banking sector has said, we're not going to, even though we're extending, pretending, we're going to extend and pretend as much as we have to and go no further than that. So the shadow banks have come along and picked up really pennies in front of the steamroller, thinking, okay, if the banking sector won't supply funds to this part of the marketplace because it really does seem to be risky, we'll do so instead. And that's one of the reasons, not the only reason, but that's one of the reasons why shadow banks were front and center in the deflationary disorder back in April. So again, that's the question. What happens if we revisit the situation moving ahead? And dealers who bailed out shadow banks in April through repo and crap collateral, if things continue to get worse, delinquencies rise, macroeconomy, labor market get worse, maybe they don't do it a second time. So what does the banking sector actually show as far as commercial real estate? Again, this is sort of putting your money where your mouth is. Banks are the extending and pretending agents, or at least they're one of the extending and pretending agents. They're working with the government, as I mentioned. The triumvirate of bank regulators have said, hey, you guys don't need to foreclose. We're okay with that. You can carry crap loans on your books, and we'll just look the other way. No big deal. And also borrowers don't want to do anything either. They just want to sit there and hope, fingers crossed that everything works out. But where it comes to extending credit, while they're pretending about the loans being serviceable enough that they can carry them on their books, banks are doing the bare minimum where it comes to commercial real estate, and that hasn't changed ever since the two major inflection points that we need to be aware of. Yeah, the bank crisis back in 2023, no surprise there. And it actually started a little bit before the bank crisis in 2023. The banking sector said, yeah, this commercial real estate stuff is going to be a problem, so we're going to start extending, pretending. And then there was another inflection last year. The inflection that I talked about all the time, I mean, March, April, and May, in that window, when the labor market really started to soften, that was not a recession scare heading into the summer. That was the labor market announcing itself that it was indeed in deep trouble. And banks responded to that by saying, okay, yeah, we're going to continue to extend and pretend, but we're going to cut back even more. And that's exactly what they did because of the macroeconomic fundamentals of the labor market, which raised the real risks of even extending, pretending in commercial real estate. And there is a bit of a disparity or hierarchy by class in commercial real estate. So everybody has zeroed in on office loans because for obvious reasons, as our Bloomberg article just did. Office loans seems to be the epicenter of the commercial real estate crisis, and maybe they will be when things really start to get into price discovery. But as we'll see in just a second, it's not really office loans. But as far as what's categorized here in the H8 statistics as non-farm, non-residential properties, or basically office loans, some retail spaces and things like that. Malls might be in here too. It's been the same inflection point in around April and May of 2024. So the labor market convinced banks that this was too risky to even extend and pretend at the same rate they had for the year leading up to that point. So they're still extending, pretending, but still trying to cut back on exposure to the office loans, except for a couple of months ago. And you notice that coincides with the meltdown in April. Ever since April, banks have been extending a little bit more credit, not a huge amount, but a little bit more credit to the office space. The irony of using the movie there, thinking about the movie. But they've been extending more credit to the office sector and the non-farm, non-residential, which that wasn't by choice. That was like repo or U.S. bank dealers bailing out shadow banks and repo. They've been extending credit because they're forced into extending and pretending even more, which to me, that's not a good sign. Again, everybody knows extending pretend is going on. Federal Reserve officials, FDIC, OCC, the big regulators, they know that it's going on. They basically sanctioned it. And the fact that it accelerated a little bit after April for likely involuntary reasons is being used as justification for reach for yield because it extended a little bit harder to try to pretend a little bit more, which is then seen by some parts of the marketplace as a form of resilience. And maybe you can look at it that way as a form of resilience when in reality, if you have to throw more good money after bad money, that's not resilience, that's getting toward the bottom of the bucket. And then we have commercial real estate loans in construction and land development. This is for a variety of purposes, but also non-residential, apartment construction. But anything related to development, completely falling off a cliff, going right back to the same inflection point. And so where it comes to those loans, which are more, by the way, those are more direct in terms of influence in the economy, though it's not a huge influence, but that's the most direct avenue for commercial real estate into the actual economy. Banks have been saying, look, you guys can reach for yield all you want. We want nothing to do with this part of commercial real estate because it continues to get worse, not better. We won't even extending and pretending in that space. So we have this major contradiction all over the marketplace where everybody knows the risks are there, and they're not just risks. Delinquencies are on the rise in commercial real estate. The potential for delinquencies and defaults are on the rise in corporate credit, yet issuance and volumes, they did fall off in the second quarter, coincident with the deflation, but they've come back. They were pretty robust in the first quarter, even though the macroeconomic fundamentals were well known then. Yet everybody wants the higher yielding paper because they want as much return as they possibly can get, understanding rates are going down. So while thinking that offers them some level of protection, it's also just basic finance and fundamentals where understanding that low rates, when they go down, they're not coming back. And so again, the contradiction, taking on additional risk for what is something that would justify taking less risk, which is why, you get credit spreads that are kind of bifurcating here. So you get the rate cut expectations driving the reach for yield that have compressed credit spreads in the investment grades to the lowest level we've seen in 25 years. We've also got recency bias, the interpretation of April as resiliency or the overreaction to tariffs. So if it was an overreaction to tariffs, no need to worry about that. And if it was a severe thing and it didn't lead to a 2008 rerun, then maybe the system is really resilient and we'll never have to worry about it either way. So if you look at April as something like a resiliency or one-off, then it justifies the additional return or reaching for additional return. But as I mentioned, the reason why the triple Cs are lingering back is because there is this awareness. As much as we want to rationalize the best case in Goldilocks, there is still the doubts in the backs of every investor's mind that maybe, just maybe, April wasn't the one-off that everybody wants it to have been. And extend and pretend in a perverse way justifies more risk taking when it should be a warning sign to take less risk. Contradictions in the credit markets that we have to be aware of, because the potential for not just, a rerun of April, but, macroeconomic consequences too, but also confirming the market sense of what we're talking about in terms of interest rates, confirming that the market believes rates are going to go low and they're not coming back anytime soon, which, even though we interpret that a little bit differently than those reaching for yield are doing, the marketplace is saying rates are going to go down and they're likely to stay there, and manifesting that view in different ways, that if rates do go down and stay there, some of these people are going to regret. So thank you very much for joining me. Really appreciate it. I'll see you all again very soon. Tomorrow we'll do another live stream. As you can see, I'm traveling here, so it's better to do the live stream. We're on the road. And yes, these people are picking up pennies in front of the steamroller. So I'll talk to you again tomorrow. Everybody have a great Tuesday.